You approve a $1 million overseas contract with a 10% margin. The customer pays 90 days later. During those 90 days, the dollar loses 10% against your functional currency. How much of your margin is left? Potentially none. NovaTech expects $1 million to convert at 0.909 euros per dollar. Euro costs are 818,000. Expected margin, 91,000 euros, or 10%. At collection, the dollar converts at 0.818 euros. Revenue falls to 818,000 euros. Costs did not move. The entire margin disappears. The product performed. The customer paid. Sales hit its dollar target, but the approved margin was an unprotected currency bet. In this episode, I will show you where foreign exchange exposure begins, how to separate 3 different FX risks, how to build an exposure register, and how a CFO combines contract terms, natural offsets, and treasury instruments to protect an approved margin. The objective is not to predict currencies or beat the market. It is to prevent an operational profit from depending on a favorable exchange rate. This is an educational framework, not accounting, tax, legal, investment, treasury, or derivatives advice. Instruments, documentation, controls, and accounting treatment depend on your entities, currencies, banks, regulations, and reporting framework. Many companies believe FX risk begins when an invoice enters accounts receivable. Economically, it may begin much earlier. Sales issues a quote in dollars. Procurement estimates costs in euros or renminbi. The quote remains valid for 30 days. Once the customer accepts it, the sales price is fixed, but the exchange rate is not. Treasury may not see the deal until the invoice is issued 3 months later. By then, the margin has been exposed throughout production. Ask one question during commercial approval. On what date does the business become unable to reprice the currency mismatch? That is the economic commitment date. It may be the accepted quote, purchase order, contract, or another enforceable milestone, not automatically the invoice date. Map the full timeline. At quote, the business proposes a price. At contract, the price and currency may become committed. During production, supplier and payroll cash begins to move. At invoice, accounting recognizes a monetary receivable. At collection, the foreign currency finally converts or remains in a foreign currency account. Each stage changes the certainty and type of exposure. If the contract is firm, but Treasury waits for the invoice, the company may leave months of margin unprotected. If Treasury hedges a weak sales pipeline too early and the sale never occurs, the hedge itself can become an unwanted market position. The right date depends on commitment and probability, not departmental convenience. Separate 3 risks before discussing a hedge. Transaction risk comes from a receivable, payable firm commitment or forecast cash flow in a currency different from the entity's functional currency. This can change cash and operating margin. Translation risk arises when a group converts a foreign operation's financial statements into a presentation currency. Reported revenue, assets, or equity can move even when the local business has not changed. Economic risk is longer term. Currency changes alter competitiveness, supplier economics, and pricing power. A competitor's cost currency weakens while yours strengthens. These risks can overlap, but they are not the same. A forward covering a dollar receivable may reduce transaction risk. It does not automatically solve translation, volatility, or long-term competitive pressure. Build one exposure register by legal entity and currency. For every material item, capture the underlying transaction, foreign currency, amount, direction, commitment date, expected cash date, confidence level, natural offset, hedge already placed, and named business owner. Direction matters. A dollar receivable is long dollars. A dollar payable is short dollars. If the same entity expects $1 million of receipts and 600,000 of reliable dollar payments in the same period, the gross exposure is 1 million, but the preliminary net mismatch may be 400,000. Do not net blindly across entities or distant dates. Cash in one subsidiary may not settle another entity's obligation. A receipt in June does not naturally offset a payment due in March. Credit risk. Banking restrictions, transfer pricing, tax, and convertibility can also break the assumed offset. Net only exposures that are operationally, legally, and temporally aligned. Treasury. Instruments are not the first line of defense. Start with the contract and operating model. Shorten quote validity, so sales cannot leave a price open for months. Add a currency adjustment clause when delivery is long. Request a deposit or milestone billing so cash arrives closer to cost. Quote in the functional currency when the customer accepts it. Price when cumulative FX movement crosses an agreed threshold. Every lever has a trade-off. Functional currency pricing transfers risk to the customer and may reduce competitiveness. Deposits improve protection, but may be difficult in the market. Adjustment clauses require clear indices, dates, and negotiation. The goal is not to push every risk away, it is to price share or remove exposure deliberately before paying for a financial hedge. Then, choose the appropriate protection tool. A natural hedge matches receipts and payments in the same currency and timing. It can reduce the amount requiring a financial instrument, but only if the offset is reliable. A forward contract locks an exchange rate for a specified amount and date. It provides certainty, but the company generally gives up favorable movement and remains exposed if the underlying transaction is cancelled or delayed. An option can create a protected rate while preserving some favorable movement, but that flexibility has a premium or economic cost. The instrument must match the exposure amount, currency, timing, and certainty. Complexity is not sophistication. The best hedge is the simplest controlled structure that protects the business objective. Do not hedge every forecast at the same ratio. Use a ladder tied to confidence and time. A signed contract with a reliable collection date may receive the highest hedge ratio. A highly probable forecast order may receive a lower ratio. Early pipeline may receive little or no financial hedge. The exact percentages belong in an approved policy. For illustration only, a company might hedge 70 to 90% of firm exposure, 30 to 60% of highly probable exposure, and 0 to 20% of early pipeline. Then stress the residual risk. Show the margin at budget rate, at a 5% adverse move, and at a 10% adverse move. Add transaction delay and volume cancellation scenarios. Hedging too little leaves margin exposed. Hedging uncertain sales too aggressively can create overhedging if the revenue never arrives. The latter must move as probability changes. Do not confuse economic risk management with hedge accounting. A derivative can protect cash economics even when the company does not apply hedge accounting, but the income statement timing may be volatile. Hedge accounting is a reporting framework designed to reflect qualifying risk management relationships in the financial statements. It requires eligibility, designation, documentation, and ongoing assessment under the applicable rules. Is the exposure economically real, and does the hedge reduce it? Second, how will the instrument and the hedged item be recognized, measured, presented, and disclosed? Never let an accounting label substitute for a risk decision, and never execute a derivative without understanding the accounting and liquidity consequences. Return to NovaTech's own $1 million receivable. Without protection, the 10% adverse conversion rate move reduces euro revenue from 909,000 to 818,000. The 91,000 euro margin falls to zero. NovaTech identifies the contract at commitment, not invoice. It locks 70% of the dollar exposure with a forward at 0.900 euros per dollar. The remaining 30% converts at the stressed spot rate of 0.818. Converted revenue becomes approximately 875,000 euros. After 818,000 of costs, about 57,000 euros of margin remains. The hedge did not maximize profit. It protected a meaningful portion of the approved economics while leaving a controlled residual exposure. Run FX risk as a cross-functional operating rhythm. Sales owns the quote currency, validity and adjustment language. Procurement identifies cost currency mismatches. Finance validates margin sensitivity. Treasury confirms exposure, liquidity and instrument execution. Accounting determines recognition, documentation and policy. Review material exposures. At least when a quote becomes committed, when probability changes, when dates move and when cash settles. Reconcile the exposure register to contracts, orders, invoices, bank positions and hedges. This week, do 3 things. First, identify the top 5 contracts where revenue and major costs use different currencies. Second, calculate the margin after a 5% and 10% adverse move. Third, find the real commitment date. If Treasury first sees the risk at invoice, measure how many days of exposure are invisible. If your margin exists only when the currency stays still, you do not have a protected margin, you have a market bet. Foreign exchange. Risk does not begin in Treasury, it begins when the business fixes one currency while its economics depend on another. Comment FX and tell me your revenue currency, cost currency, and country. Subscribe to Global CFO Playbook for practical finance systems for international growth. Next episode, headquarters charges every subsidiary a 5% management fee. The journal entry balances but the tax story does not.